topic this afternoon is the financial crisis. I don't know if we should call it the recent financial crisis or the ongoing financial crisis, but let me begin with a disclaimer which was brought home to me at lunch when I mentioned that my retirement portfolio had crashed, and I was asked, not unreasonably, what? You stayed in the market? You didn't go to cash in 2007? So, you know, I meant to, but I'm an absent-minded professor. I just never got around to it. So think of this as economic history, not as a forecast, although I'll talk about what we might reasonably expect going forward. So how did we get into a situation where we had failures of large banks, Fannie Mae and Freddie Mac, AIG? Well, as is well known, the cracks began appearing in the housing market, in the housing finance market. And if you want to look for evidence that housing was overfinanced, here it is. This is from the Board of Governors series on real estate loans at all commercial banks. So they look at all commercial bank balance sheets and add up every asset that's in the category of real estate loans. And the circled area shows you a period in which the growth rate, this is year-over-year growth, in real estate loans was consistently between, well, above 10%. It falls during the recession of 2001, but afterward, it's between 10 and 17.5% for several years. It averages around close to 13% during those years. This is far faster than anything else was growing, faster than the real economy was growing, faster than the population was growing. Housing was being built well ahead of any reasonable projection of demand for it in retrospect. This is clear. It couldn't all be sold. Roger Garrison likes to use the analogy, which is originally from Mises, that to explain why the financial crisis has to arrive, why the boom can't go on forever, you have to imagine a situation in which Boris, who's the commissar of housing, is given a pile of bricks and draws up plans to build 10 houses from the bricks because he thinks he has enough bricks to complete 10 houses. But when he gets halfway through the building, he realizes there aren't enough bricks. Right? And likewise, in Austrian business cycle theory, there aren't enough savings. There aren't enough real resources to complete all the projects that have been undertaken. And so Boris is going to have to knock down a couple of the half-built houses in order to, if he's going to finish the number that can be finished, say 8. But a lot of bricks are going to be destroyed in the process. Right? So malinvestment cannot be costlessly reversed, and we're stuck with the lower potential for the economy because we've malinvested capital. Well, you can see the malinvestment in real estate, and if you want to see it in 3 dimensions, drive to the outskirts of Las Vegas, and you can see condominium communities, rows and rows of condominiums that are unoccupied, unsold, some of them uncompleted. Some of you may have seen the video of a bank that decided halfway through the building of a set of condominiums that at this point the best thing to do is to scrap it, and you literally see the bulldozer knocking down half-built condominiums. So that's how we got here, and the thing that I didn't predict and that few people predicted, but maybe Peter Schiff, was what the knock-on consequences were going to be of this overexpansion in the housing sector. We knew that it was clear there were going to be losses taken there, but how fragile the banks were that had overinvested in housing, and the mortgage resellers, Fannie Mae and Freddie Mac, came to as a surprise to many people. I knew Fannie Mae and Freddie Mac were going to fall, but as I said, I never got around to shorting their stock. Here's another measure. It's a little less dramatic, but another measure of over-stimulus from monetary policy. So the real estate, the last slide we saw, those loans have to be financed somehow, and they're being financed by credit expansion by the Fed. I'll show you some evidence of that later on. So what we're looking at now are the consequences. This is a measure of gross domestic product, but we've taken out net exports, or rather the Fed has taken out net exports and changes in inventories, because those are not really sales. Those are just piling up because stuff was built that couldn't be sold. So if you look at the growth in final sales to domestic purchasers, you see this spike, or I guess it's kind of a mesa. Between about 2003 and 2006, growth is faster than the trend, and so there's more activity, and some of it spills over into the real sector. There's over-construction, as we saw in the previous slide, or over-financing. But this basically represents the overconsumption part of the overconsumption plus malinvestment. So how's it being financed, or what's the fuel for this? It's monetary policy. So here's M2 growth, and what I've circled is the period in which M2 growth is well above trend. Right? So discounting this previous peak, which helps explain the dot-com bubble. Coming out of the recession of 2001, Greenspan's got his foot flat on the accelerator, and we get a peak year-over-year growth rate of M2 of over 12%, but we get a long period in which it's above 6%. It decelerates coming out of 2003, but a lot of the damage had been done by then. If you prefer M1, here's M1, similar picture. And if you want to look at the consequences for the loanable funds market, here's the real interest rate. So the real interest rate is the current Fed funds rate, Fed funds rate and the one-year Treasury yield are plotted here, minus the contemporaneous inflation rate. And you can see it's negative for about 2.5, almost 3 years. So if you, just to pick a random example, borrowed money and invested in vacant land, right, which basically has a zero cost of storage, you have to pay some real estate taxes, I suppose, and its value just rose at the rate of inflation, you'd be making a profit. Right? If the real value didn't change, since you're borrowing at a negative real interest rate, you can repay the loan and have something left over. So a negative real interest rate means it pays to borrow money, almost regardless of what you do with it. Probably the best way I've heard it put was, if you invested during this period in treasury bills, right, one-year treasuries, you got negative real returns. If you invested in toilet paper and put it in a warehouse, its price rose at the rate of inflation. You did better investing in toilet paper than in treasury paper. Right, so that's negative real interest rates. Now, how do we know these interest rates are too low? Well, there isn't any one size fits all test or one infallible test, but here's a sort of test or a way of measuring how easy monetary policy is, which is actually quite popular among mainstream economists. It's the Taylor rule. All right, so the Taylor rule tries to estimate what Fed funds target, right, for the Federal Reserve. The Federal Reserve operates by setting a Fed funds target and instructing the open market desk lend as much as is necessary to hit that target. What Fed funds target is consistent with hitting an inflation target. So if you think of the inflation rate as the goal and the Fed funds rate as sort of the instrument, it's giving the Fed the feedback as to whether it's too loose or too tight. And the way that the Taylor rule works is if inflation goes up by a percentage point, then you raise the Fed funds target by slightly more than a percentage point, and that way the economy is supposed to converge on an equilibrium. Well, here's Fed policy during the period leading up to the bursting of the bubble, and coming out of in the middle of the recession of 2001, the Fed funds rate drops below the path that would have been consistent with 4% inflation. which is the lowest of these paths, running from 0 to 4%. So this Fed funds rate then is consistent with something like 6 or 7% inflation. We'll talk in a minute about why we didn't have 7% inflation. But it's too low. It has a short period of being within range. The Fed's comfort zone, by the way, is supposed to be 2% inflation, or that's supposed to be the highest rate of inflation in their comfort zone. So if you look at the gap between the path the Fed was on with a 1% Fed funds rate and the rate that would have been consistent with 2% inflation, according to this simulation, a little over 4%, 300 basis point difference there. That's a huge gap. If you extend this chart backwards, you don't find any gaps that big. This is from the St. Louis Federal Reserve publication, Monetary Trends, by the way. It's available free on their website, and it's got a lot of useful indicators if you're into that sort of thing. But the period of interest rates being too low for too long is actually quite long. It's not until mid-2006 when the Fed funds rate comes back into the reasonable range that the Taylor rule would have had it in. And of course, John Taylor himself has noticed this, and he's published a few papers making this point, basically centered on this kind of diagram. He now has a book out. It's about 90 pages long. You can, read it on your lunch break. It's published by the Hoover Institution, so I'm sure if you wait a few weeks, it'll be available free on their website. But it's currently available through Amazon. Anyway, this is indirect evidence, not a perfect indicator, but evidence of the Fed funds rate being held too low, too long, and thereby indicating that Fed expansion is spilling over into the loanable funds market, driving the interest rate in the market below an equilibrium rate consistent with equilibrating savings with investment. So in my book project, in the chapter on the Roaring Twenties, I try to distinguish between the advice Hayek was giving monetary policy authorities, central banks, and the advice the real bills doctrine people were giving the central bank. And I realized that the real bills doctrine policy diagram, which is on the right, could equally well be used to describe Fed policy in the current period, not just in the 1920s or 1930s. So here's Hayekian policy in the face of an increase in the demand for loanable funds. So let's suppose that just out of the blue, investors get it in their heads that housing is going to be the next big investment boom. I don't know if you saw the article in The Onion that said, with the housing bubble gone sour, investors demand new bubble. We don't have any place where we can invest our money and get unsustainable returns, they said. So in the face of, suppose this notion becomes widespread and people think that there's going to be a boom in housing and this is a great investment opportunity, or it could be investing in web-based companies that are going to deliver dog food to your house when you order it online. That kind of demand for loanable funds is going to shift the demand curve to the right, that kind of investment optimism. But if the monetary authority lets that be, doesn't intervene, the interest rate starts to rise. And the interest rate rising will sort of choke off the boom. Hayek referred to this as the interest rate brake on the economy. It prevents the investments from going too far. If there really are investment opportunities, then some of them it makes sense to finance, but to finance at a higher interest rate in order to induce savers to give up more savings, and in order to induce investors to give up lower return projects for the sake of these new higher return projects. But you don't want to take it too far. And so the interest rate does its job then, when it rises, to ration the supply of loanable funds to the prospectively most productive uses. Right? So the new equilibrium is not unsustainable. If the investors are right about the new high productivity investments, high return investments, that's the new equilibrium. But here's Fed policy. Fed policy was, as demand for loans went up, the Fed said, well, we don't want to let the interest rate rise. We want to keep the interest rate low. If you keep the interest rate low, that means you have to shift the supply of loanable funds to the right as the demand shifts to the right. You move along this dotted line, and that implies increase in the money supply. So an expansion of credit not provided by savers, right, from here to here, there's the expansion of credit provided by savers. This is credit provided by running the printing press. Right? So when you do that, you get an unsustainable short-run equilibrium. Now you've got an interest rate that's too low to ration the genuine savings to only the most productive investment projects. At this lower interest rate, you got overinvestment, right? You got, and in particular, malinvestment. You've got projects being financed that look like they're worth financing at a low interest rate, but wouldn't be worth financing if the interest rate were telling the truth about how scarce savings actually are. So we've already seen where the credit went. This is the same slide again of real estate loans. Now, I said that the Taylor rule is predicting, as a result of the low Fed funds rate, that there should have been 6 or 7% inflation. We didn't see that. We saw only mild inflation in consumer prices. So here's the GDP deflator. By the way, the GDP deflator, as you can see, has been fairly stable, running between 2–3.5%. When the CPI was running at 5% year over year, the Fed said, oh, we're not looking at the CPI, we're looking at the GDP deflator. See how well we're doing? Now that the CPI has, or in recent quarters, has sometimes registered slightly into the negative range, the Fed has been saying, look at the CPI. Deflation threat. We have to be expansionary. Somehow now they've forgotten about the GDP deflator, which is reporting, right up to the present, that we've got 2% plus inflation. We're not in a deflationary era. So why is inflation in some sense being under-registered here, right? It only goes up to 3.5. Where's the 6 and 7% inflation? Oh, here it is. It's in asset prices. Right? Looking only at consumer prices misses a large part of where the new money can go. Because the GDP deflator only measures the prices of newly sold goods and services, doesn't measure prices at yard sales, doesn't measure asset sales, doesn't measure stock prices, doesn't measure housing prices. Wait, don't consumers buy housing? Oh, no. Consumers receive a flow of rental services from housing. So the GDP deflator just looks at rents, doesn't look at house prices. All right, so if the interest rate goes to 0 and the house price goes to infinity, because it's the discounted value of the infinite stream discounted at a 0 interest rate, doesn't register in the GDP deflator or in the CPI. But here are asset prices. I'm not sure whose index this one is that I stole from some website or exactly what's being measured, but it purports to measure aggregate asset prices. Here's one that's, of course, I always tell my students, no anonymous web junk. Sorry. Don't give me a citation to Wikipedia unless you can tell me who wrote the article. Because I've discovered in the past that when I challenge a fact that a student purports to be citing in his paper, and I say, that's not a fact, he says, well, give me 10 minutes and then check Wikipedia. I'll show you it's a fact. Here's a less anonymous index, the Case-Shiller Home Price Index. Case-Shiller, by the way, was my freshman economics instructor. Who knew? And we see house prices rising at a rapid rate. And then this is percent change over a year ago, and then plummeting. So why housing in particular? So I want to go through briefly a list of the ways in which federal policy, other than monetary policy, encouraged overinvestment in housing. First we got Fannie Mae and Freddie Mac. I love Freddie Mac's slogan, "We make home possible." They might want to revise that.
We make foreclosure.
We make foreclosure possible. That's one thing they could say. We make former home possible. But what are Fannie Mae and Freddie Mac? I'm sure you've heard the names. They are government-sponsored enterprises. That's the artful term used, which means they have private shareholders, but they were created by Congress and given a mission, or as they like to say in D.C., they were tasked, because any noun can be verbed. They were given the task of basically expanding home ownership by refinancing mortgages, or creating a secondary market, to be more accurate, in home mortgages. So they buy up a whole bunch of mortgages into a pool, and then they sell shares of the pool. These are called mortgage-backed securities. It's a little misleading. When I first heard the phrase, I thought it meant, oh, there's some intermediary, you buy its IOUs, and its assets are mortgages. And no, it doesn't work that way. You buy a share of the mortgage pool. It's securitized in the sense that the interest payments on the mortgages are bundled together and doled out to all the holders of shares of the pool. But your claim is on the mortgage, it's not on some intermediary. So Fannie Mae and Freddie Mac create these pools and then either hold them themselves or more often sell them to institutional investors who hold these mortgage-backed securities. Mutual funds, insurance companies, and so on. Now, Fannie Mae and Freddie Mac discovered they had a very valuable franchise because they could borrow money at very low rates, just above the Treasury rate, and then use it to buy mortgages, which would pay them a return many basis points above the Treasury rate. So they had a big spread. And the key to this big spread was that they could borrow so cheaply. There were private institutions that tried to get in on this business too. They couldn't banks, they couldn't, Wells Fargo in particular, they couldn't borrow quite as cheaply as Fannie Mae and Freddie Mac. And the more valuable this spread became, the bigger and bigger Fannie Mae and Freddie Mac grew, from hundreds of billions to trillions, to where together they owned or guaranteed, because when they would sell off the mortgages, they often guaranteed that they would be repaid. Owned or guaranteed something like 60% of all the home mortgages in the United States. So these are the two biggest financial intermediaries in the U.S. economy, and of course they crashed. How could they borrow so cheaply? Well, let's look at the names. Fannie Mae is short for FNMA, which is the Federal National Mortgage Association. And I forget what Freddie Mac stands for, but something similar. Federal Mortgage Assurance Corporation, something like that. They were regarded by investors, despite their legally private status, as having an implicit guarantee from the Treasury, such that if they were ever in a position where they couldn't repay their bonds, but who could imagine that, because they were too big to fail, the Treasury would step in. Now, Barney Frank assured us that this was not true. All right? And at the same time, he said Fannie Mae and Freddie Mac have a special responsibility to the taxpayers because of the special privileges they have. Well, what's the privilege they have except being able to borrow money with the implicit guarantee of the Treasury? That was the key to them being able to borrow so cheaply and thereby to grow so huge. But given that they, and you might ask, well, why doesn't Congress sort of pay more attention to how rapidly they're growing and how dangerous their position is coming? And the answer is, because they were private enterprises, they were legally allowed to buy congressmen. Well, they were allowed to take out mortgages on congressmen, I should say. They had a huge campaign chest which they lavished on members of both parties. And so some of the profits were, some of the rents were being shared around Capitol Hill. But because there were these profits, they could be pressured into pursuing political missions at the behest of Barney Frank. And the mission was to promote home ownership. Right? So it wasn't good enough to have 64% of the public owning their own homes. It should go up. And mortgages should be made available to people who don't qualify for traditional mortgages. We already had other programs to do that, but Fannie Mae and Freddie Mac had the money, could borrow money cheaply to make that dream of home ownership come true, temporarily. But the agency that put the pressure on Fannie Mae and Freddie Mac, and when I say pressure, I don't just mean subtle persuasion at cocktail parties. I mean, Department of Housing and Urban Development gave Fannie Mae and Freddie Mac quotas. You must devote this share of your portfolio to mortgages to borrowers who have less than the median income in their communities. And that target went up and up over the years till it was about 50%. And in addition to that, you must devote a share to borrowers whose income is 60% or less of the median income in their community. So these are people who normally did not have the income or the credit worthiness to qualify for a mortgage. These were the mortgages that became the so-called subprime mortgages, or the Alt-A mortgages. You can lump them together and call them non-prime mortgages, but borrowers that banks traditionally wouldn't touch. There were some other wrinkles whereby community activist groups like ACORN were given some muscle because banks that didn't lend back into the communities where they, that's my next, that's my fourth, actually, piece of the puzzle. Under the Community Reinvestment Act, it's separate from Housing and Urban Development, but it's similar. The Community Reinvestment Act was an act passed in 1977, which initially was just a reporting requirement. And banks complained about the burden of paperwork, but it wasn't really constraining their behavior much. And what community reinvestment means is if you gather deposits in this neighborhood, we're going to keep track of how many loans you make back to the neighborhood. So the depositors are coded by zip code. The borrowers are coded by zip code. So we can match them up in that way. So if you didn't lend back at least 80% into the zip code where you collected deposits, you weren't doing your job of promoting community reinvestment. So if, say, you were gathering deposits in the state of Maine, where there are old retired people, and you weren't lending them into Maine because nothing was being built in Maine, you were not serving the community credit needs of Maine. If you dared to send those funds to Florida, where there were people who actually wanted to buy houses, shame on you. But the Community Reinvestment Act was initially just a reporting requirement. It was given teeth during the 1990s. And the administrator who was the most zealous at, the enforcement of the Community Reinvestment Act is given to the Federal Reserve System. When the Community Reinvestment Act was revisited, the teeth were of the following form. If a bank wants to have its merger approved, right, in the mid-90s is the era of lots and lots of bank mergers because the legal barriers to interstate branching came down. So lots of banks are now marriage partners, merger partners. If a bank has a poor Community Reinvestment Act score rating, their merger might be disapproved. If a community activist group, I forget the label it's given in the legislation, but if there are complaints from the community that the community is being underserved, this counts against the bank. So this is a license to ACORN and groups like it to extort the banks, to say, look, if you don't partner with us to make cheap loans into our neighborhood, we will go and lobby the Fed and say that you've been a bad bank, and it'll be difficult for you to get approval for your merger. One reaction to the Community Reinvestment Act that some banks took was, okay, I'm gathering deposits in a poor neighborhood. There aren't many investment opportunities here, but now I'm being penalized for this, for not lending back into the neighborhood. I got two choices. I can lend into the neighborhood and lose money on that, or I can close my branches in that neighborhood and stop collecting deposits. And so some poor neighborhoods found themselves even less served because banks were closing their branches and moving them away. There was a bank in Maryland that was actually singled out and dinged for this and said, how dare you close your branch in the poor neighborhood? And they said, well, you told us we had to lend into the poor neighborhood if we had a branch there, so we didn't want the trouble. But there were banks then that partnered with community groups to make millions of loans available. It's not a big part of their portfolio, so it's not a major cause of the subprime crisis, but it is part of it. The Federal Reserve did its own study. This study was chaired by Randy Kroszner, who used to be a free banker. You can interpret for yourself what happened to him. But Kroszner reported that only about 9% of all subprime loans had any connection to the Community Reinvestment Act. Okay, well, it's not zero. It's not huge, but it is 9%. It's something. Assuming, I haven't gone through the methodology of the study to make sure they're not undercounting, but that was their own estimate. So it may be just a small piece, I'm not sure, but it is something. And it did kind of create an environment where banks were experimenting with relaxing their credit standards. Right? They were being explicitly encouraged to do so. Now, if these new loans had immediately proven unprofitable, banks probably would have shrunk away from it and probably wouldn't have created much of a problem. But these loans didn't immediately prove unprofitable because the Fed, meanwhile, was creating the housing bubble, where housing prices are going up and up and up, as we saw in the Case-Shiller index. If house prices are going up and up and up at 10% a year, every housing loan is good. So default rates were remarkably low, not just on prime mortgages, mortgages that met the ordinary underwriting criteria, but even on subprime mortgages. And banks looked at this and said, oh, wow, it looks like these things aren't the bomb, the ticking bomb that we thought they were. So let's pile in, because we get bigger spreads on these than we get on conventional mortgages. Now, this is a little bit amusing. If you read evaluations of the Community Reinvestment Act by the Fed back before anybody started blaming it for the subprime fiasco, the Fed emphasized how much impact, this positive impact this act was having on bank behavior. It had all kinds of demonstration effects. It had showed banks that they had been too conservative in the past, and it was a good thing to be a creative lender. And it worked, right? And now that the chickens have come home to roost, the new Fed study is, oh no, Community Reinvestment Act didn't change any bank's behavior. It was completely innocuous. I was going to say, at Housing and Urban Development, the administrator who was the most active at promoting relaxing of credit standards was Andrew Cuomo. And Cuomo, of course, is a big fan of the Community Reinvestment Act as well. The last thing I want to mention is the Federal Housing Authority, FHA. Is that the right acronym? Authority? Association? Administration, thank you. I didn't think authority was right. Administration. The FHA makes loans available to us, guarantees loans made by banks to qualifying borrowers, a kind of small set of borrowers. The percentage of mortgages which are FHA guaranteed is not all that large, but it again has a kind of demonstration effect. The FHA used to require 20% down payment. Then, in order to encourage more home ownership, they made it 10% and then 5%. And now, I don't know if it's changed recently, but a couple of years ago, their most popular program had only a 3% down payment requirement. And so banks making non-FHA loans felt compelled to match that, or seemed to have been inspired to match that, and began cutting their own down payment requirements. And of course, it's the mortgages with the smallest down payments that went into default the most frequently. One other thing I should mention that resulted from this combination of encouragement to practice creative financing. Oh, sorry, one thing I wanted to mention about Cuomo was he singled out for praise one of the lenders who had shown the most creativity in relaxing their standards, and that was Countrywide Financial. And Countrywide was the first big lender to bite the dust. Countrywide was purchased by Bank of America, and now Bank of America is not doing so well. The other contribution, if you want to call it that the Fed made was by pushing the Fed funds rate and the one-year Treasury rate down so low, right from the peak before the 2001 crisis to the 1% rate, interest rates fell 525 basis points. At the short end, that's the Fed funds rate and the one-year Treasury rate. Long-term interest rate, 30-year mortgage rates fell a little bit, 113 basis points, not nearly so much. So when Bernanke says the reason interest rates are down is a glut of savings from Asia, there's a little bit of truth to that. Long-term interest rates, which are not really closely controlled by the Fed, were down a little bit, and I'm willing to attribute that to the glut of Asian savings, but that doesn't explain 500 basis points of interest rate drop. And because the short-term rate was pushed down by Fed policy so far below the long-term rate, which didn't move all that much, it set up an incentive, right? It's cheaper to borrow short than long normally, but when the spread between the two is at its normal distance, the marginal borrower should be indifferent between the two, because it's a little riskier to borrow short and then have to roll it over, and the risk is interest rates go up and you get caught refinancing at a higher rate. But when the gap is huge, people take out mortgages that are financed with one-year money. That's called an adjustable rate mortgage. Right? So instead of being a 30-year fixed rate mortgage, it's a series of 31-year mortgages refinanced every year at whatever the current interest rate is. Now, if you can count on the current interest rate remaining at very low levels for 30 years, you've got a winner. And people who took out one-year ARMs, adjustable rate mortgages, were implicitly betting that the rate wasn't going to go up, at least while they held the mortgage. Right? So they were playing a kind of game where they thought either the rate's going to stay low forever, probably nobody was that naive, or I'm going to get out of this house before the rate goes up. I'm going to flip it, or I'm going to move. I'm going to sell it to somebody else. Well, some people got caught in this game of musical chairs. But the share of new mortgages that were written as one-year ARMs went from about 20% to about 40%. The share doubled. It's a huge change in the risk people were willing to take because the attraction was so great. The short rate was so much below the long rate. And those mortgages are also doing badly. And the biggest bomb of one-year adjustable rates that are about to reset, because often they had a preliminary period of 3 to 5 years of fixed rates and then the reset occurs, there's a big clump of those due to come in the next couple of years. So the mortgage default crisis is not over. It's going to be another wave. Okay, so what now? Let's turn from the depressing news to the cheery news about what the Fed's been doing. And this diagram shows you how creative the Fed has become. So up to about 08, end of 07, here's the Fed's portfolio. Right? So this is the things that the Fed is acquiring on one side of their balance sheet. The money supply, the monetary base to be specific, right? Federal Reserve notes in circulation and Federal Reserve deposits held by banks, that's on the other side of the balance sheet. So the two sides move together. So there's not much expansion and there's not much change in the composition of the portfolio. The big part is treasuries. Right? So the Fed's portfolio is about 85% treasury obligations on the asset side and about 90% Federal Reserve notes on the liability side. Then the crisis begins to hit, and the Fed begins to, instead of keeping its portfolio mix the same and trusting that if there are credit-worthy financial firms out there who need to borrow money, who are fundamentally solvent, they will be able to find lenders. That was the traditional presumption. Let the market sort out who's credit-worthy and who isn't. The Fed decided to judge who's credit-worthy and who isn't, or what sectors of the financial market deserve how many hundreds of billions of credit. And so they began to make all kinds of strange loans and acquire strange assets, stuff that they previously didn't touch. So here we got a list of some of the new investments. So starting at the bottom, let's see, repos didn't change much at first. TAF, that's the term auction facility. So traditionally the Fed, as a lender of last resort, was supposed to provide, and did provide, overnight loans to banks who had trouble meeting their reserve requirements, basically, otherwise. But it was trivial amounts, right? It was in the millions, whereas everything else on the balance sheet is in billions. But the term auction facility was the Fed will auction off funds to banks for longer periods of time. Right? It used to be that if a bank wanted to borrow money for 90 days or longer, they had to go into the marketplace and find somebody who thought they were creditworthy. Now the Fed will lend it to them. And this term auction facility, you can see, grew and grew and grew, became pretty big. Discount window plus PDCF. I forget what that stands for. Anybody remember?
Primary dealer credit.
Thank you. Primary dealer credit facility. That's loans to brokers. Brokerage houses. The Fed never used to lend a dime to brokerage houses. The Fed's mission was to make sure that solvent banks have enough liquidity, not other financial firms. They were supposed to borrow money in the market. Now, I do remember the ABCP MMMF. That's the asset-backed, wait, I'm starting to blank. Thank you. Asset-backed commercial paper money market mutual fund facility. So they had a program for buying commercial paper from mutual funds who were facing redemptions. There were 2 days of heavy withdrawals from mutual funds. The mutual funds cried to the Fed, and the Fed said, oh, well, we can't let that continue. We can't let that market reach equilibrium. Mutual funds are not run-prone, right? There's no advantage in pulling your money out now rather than later because you're worried about other people withdrawing. You get your share of the portfolio whatever day you withdraw. But the Fed was convinced this was going to be a crisis, so they started lending back into that market to buy up the assets from the mutual funds. AIG credit. Well, we all know AIG was the huge insurance company that failed, and the Fed began lending it money. The commercial paper funding facility, the Fed began buying commercial paper directly. Right? Not from intermediaries, but from firms that were trying to issue commercial paper. That is, issue IOUs, short-term IOUs, in order to fund their operations. The money market investor funding facility, lending money directly to money market mutual funds, I think. Hard to keep track of them all. Maiden Lane. Okay, Bear Stearns fails. Of course, Bear Stearns says, we're not insolvent, we're just the subject of an irrational bank run. We can't roll over our portfolio with short-term loans because the people who would lend us money are worried that tomorrow somebody else won't lend us money. That's the only problem we have. And so they go through this liquidity crisis. On a weekend, this is all reported in a Frontlines report, which I recommend to you if you haven't seen it. But when you watch the Frontlines report, I do want you to... so they go around and interview people involved in Bear Stearns and neutral third-party economists commenting on the Fed's actions in this case. I do want you to be aware that when they interview Mark Gertler from NYU, they might have in his caption said, co-author with Ben Bernanke. And when they interviewed Paul Krugman, they might have said, was hired by Ben Bernanke to teach at Princeton. So some of these neutral economists are not quite so neutral. So Bear Stearns has this problem. The Fed says, well, let's see, we did such great work in long-term capital management. Let's see if we can arrange a private sector rescue of Bear Stearns. So they open up the books of Bear Stearns. The potential investors come in and look. And what do you know? Bear Stearns really is insolvent. It's not just a liquidity problem. People who were refusing to lend them money because they didn't want to be the last ones holding the bag had a very good reason not to lend them money. They weren't going to be able to pay everybody back. But the Fed says, well, we can't let Bear Stearns fail. So they arranged a marriage where J.P. Morgan Chase bought them. But J.P. Morgan Chase said, well, we've had the weekend to look at the books. We're not sure how toxic the assets are. Here, why don't you do us a favor and buy $30 billion of the assets, or pay us $30 billion for these assets, which we're not sure are really worth $30 billion. And the Fed says, okay, but you know, it sounds like a great investment opportunity for the American people. But you know, under the Federal Reserve Act, we're not really supposed to own stuff like that. And the lawyers at the Fed said, hey, no problem, we can create a subsidiary. Let's call it, since our offices are on Maiden Lane, let's call it Maiden Lane Limited Liability Corporation. So Maiden Lane is owned by the Federal Reserve Bank of New York. But see, it's not the Federal Reserve Bank of New York. It's only a wholly owned subsidiary. This is the kind of balance sheet shenanigans that commercial banks have been accused of doing to hide their bad assets. So the Fed acquired $30 billion of Bear Stearns assets. Oh, by the way, they've now been marked down to $27 billion. This is the first time in history the Fed has recorded a loss on an asset class on its balance sheet. But it gets better. They need to buy stuff from AIG. They form Maiden Lane 2. They need to buy more stuff from AIG. It's collateralized debt obligations. They form Maiden Lane 3. Foreign currency swaps have gotten really big, which is basically the Fed making credit available to foreign central banks in dollars so that foreign central banks can make it available to U.S. banks or other banks overseas who are doing business in dollars. Right? Because the Bank of England can't ordinarily just make dollar-denominated loans to banks in London that are doing dollar business. So this is extending the, well, let's call it a bailout, extending the bailout to dollar-denominated bank operations overseas. Now, if you notice this, the total of Fed assets doesn't change much up until '08. In other words, the Fed is offsetting the new loans by selling off T-bills from its portfolio. But then the Fed's portfolio skyrockets, and if you look at the scale, it more than doubles. So the Fed's assets go from a little less than $1 trillion to more than $2 trillion. And what's happened to the Fed's balance sheet? The Fed used to be, as I said, 85–90% invested in T-bills. It was very safe. It had about 4% capital, which was plenty given that its assets posed no risk. Now it's got 2% capital because the same capital is supporting double the assets. So its leverage is now 50-1. And what are its assets? Toxic junk. The Fed has become a highly leveraged toxic hedge fund. It's, as I said, it's experienced losses on its Bear Stearns assets. It's not clear yet how much it's going to lose for the American taxpayer on these other assets, but there is and on top of that, the Fed is now paying interest on bank reserves, so its expenses have gone up, its income has gone down. The Fed is not going to be able to contribute quite as much to the Treasury at the end of this year. I'm waiting for the Fed's next income statement. It's audited on, it's reported on a fiscal year basis, so it should be fairly soon that we find out how much net income the Fed had over the last 12 months. That should be interesting to see. In response to this, this is a footnote, in response to this concern that the Fed was now too thinly capitalized, you know, I used to make fun of the idea that the Fed needed capital because it didn't have to repay its debts. right? You can't get anything for a Federal Reserve note. It's not really an IOU. I met an old economist named John Exter who said, under the gold standard, a banknote was an IOU. Under a fiat standard, a Federal Reserve note is an IOU nothing. Right? So the Fed can't be called upon, doesn't really have liabilities, so why would it need capital? Right? And it can't lose anything on its assets. Well, now it can lose something on its assets. So in response to this concern, a defender of the Fed said, oh, but if we reevaluate the gold on the Fed's balance sheet to its market price, then the Fed has plenty of capital. Well, that's true if you don't reevaluate anything else. But all this junk is being carried at its book value. It's not being marked to market. It's hard to market because the Fed has bought stuff that nobody else wanted to buy. So there really isn't much of a thick market for this stuff. But this portfolio is what concerns people about the Fed's exit strategy. If the Fed had expanded only by acquiring T-bills, the exit strategy is easy. There's always a market for T-bills. You can sell them very easily and contract the portfolio. There is no market for this stuff currently. The Fed's exit strategy consists of wishful thinking that when the Fed decides it's time to contract, there will be a market for this stuff. All right? Remains to be seen. But I guess Bernanke had a piece in the Wall Street Journal reassuring us, so we should all be reassured that when an exit strategy is needed, they will have one. Here are the items on the Fed's balance sheet, just to give you an idea of the magnitudes. The big change was basically between April and April. It's pretty much stabilized now. Some things have actually begun to shrink on the Fed's balance sheet slowly. But between April 29, 2009 and April 30th, 2008, and these numbers are all from the Fed's own balance sheet reports, which are just Google Fed H41. That's the name of their weekly balance sheet statement. I never thought I'd be watching the Fed's balance sheet week by week, but when I was teaching money and banking, that was the way to actually figure out what the Fed was doing. Because, you know, the financial press has no idea. I begin to wonder whether they've ever, you know, taken basic bookkeeping. But there's a blogger named Jim Hamilton who has also done good work sort of tracking the Fed's balance sheet. Anyway, the Treasury securities basically flat, really no change over that year. That was after the Treasury portfolio shrank. But on the right-hand column, you see the change since 2008. Sorry, it's not quite lined up right. But the mortgage-backed securities that the Fed has, all new. The Fed never used to invest in that kind of stuff. Term auction credit, it had already started before April 2008, but it went from 100 billion to 400 billion. Other loans, 100 billion, 71 billion of that is new. And the credit extended to AIG, 44 billion. Term asset-backed securities, liquidity facility, that's all new, but that's a mere 6 billion. Commercial paper funding, 181 billion, all new. Bear Stearns, originally 30 billion, now down to 26.5. AIG's mortgage-backed securities, AIG's collateralized debt obligations of other kinds. And then the central bank liquidity swaps are a big item over there. But in total, the Fed's assets went from less than $1 trillion to more than $2 trillion. So more than doubled. Here's a chart that tries to give you a picture of the magnitude of potential intervention by the Federal Reserve. So these balloons are not the actual amounts that we just saw, but they are the amounts that the Fed said it would be willing to lend up to if there were a need. So up to 900 billion, up to 250 billion. And you kind of lose perspective. It's just like a chart of the planets. It doesn't really give you much of an idea of how big these things are in absolute terms until we put it in perspective with the American Recovery and Reinvestment Act. That's the $878 billion Treasury bailout. The Fed's bailouts dwarf the Treasury's bailout. Right? Even the amount the Fed has actually lent is about 1.2 trillion in these new kinds of loans to financial firms, much bigger than 787 billion. And And it's gone completely under the radar. Nobody's debating, nobody's hardly noticing what the Fed has been doing, the risky loans it's been making on behalf of the American taxpayer. And why is that? Well, because the Fed finances it themselves. They don't need to go to Congress and argue for these programs. They don't need to ask Congress for the money to fund the programs. The Fed funds it themselves by writing a check, by printing money, to put it metaphorically. I mean, it's all done electronically, but the Fed is self-financing, as they say, until the Fed makes enough bad investments that it has negative income and then needs to go to Congress for an appropriation. But for now, the Fed is self-financing. So there's been very little debate over the Fed's bailout programs. There are some members of Congress who would like to examine the Fed's fiscal operations. Right? I guess I've mentioned this before. On the right, you got Ron Paul. On the left, you got Bernie Sanders. Say, Mr. Bernanke, tell us who you lent the money to. Nope. Can't do it. Why not? I'm independent. Right? And I showed you the petition recently from a bunch of economists defending the Fed's independence. But independence was supposed to apply to monetary policy. This is not monetary policy. This is fiscal policy. This is lending money to favored groups of borrowers. Goldman Sachs. This is the sort of decision that elected representatives used to get to argue about, right? So we had a debate over whether to lend money to General Motors and Chrysler. Debate didn't come out, the decision didn't come out the right way, but nonetheless, at least there was a debate. Here, there's no debate. And saying that the Fed's independence is compromised by people who want to ask where the money went, well, the Fed, hasn't been independent at least since Ben Bernanke called up Hank Paulson and said, we need to go to Congress and get authority for the treasuries to start lending $800 billion so that we can distract attention from what the Fed is doing. He didn't actually say that last part, but I think he meant it. So what next? Well, so here's the other side of the Fed's balance sheet. Here's the Fed's liabilities, the monetary base, M0. Boing. This is completely unprecedented. The monetary base has never doubled. There have been, as you can see, little spikes. This is the Y2K spike, and then it's withdrawn. There's a little spike downward in 2001. It's reversed. Where's 9/11? I guess this is 9/11. There's a small spike. But nothing on this magnitude. So, yeah, we all know that the equation of exchange is a little too simple. It masks a lot of important things. But it does give you a kind of first blush estimate of what the impact on the price level is going to be. And holding velocity and real income constant, a doubling of the monetary base results in a doubling of the price level. Why haven't we seen that? We've seen less growth in the broader monetary aggregates, the kind the public actually spends, M1 and M2, than we have seen in the monetary base. But nonetheless, it is getting traction on M1. So over the last year, we've had 15 to 20% M1 growth. That's year over year. And that's not just taking 1 week and extrapolating. That's year over year. So that's the sort of thing where the velocity of M1 is not traditionally all that unstable. We should start to expect to see double-digit inflation. Here's M2 growth, not quite as extreme, but between 8 and 10% year over year. We already saw this chart for the previous period, but I had artfully blocked out the last part of it. Here's current monetary policy. Fed funds rate way below what the Taylor rule is indicating. And remember, the Taylor rule isn't just premised on inflation, it's also premised on how far the economy is below the notional full employment level of income, or the natural rate of output. So it calls for an increase in money growth or a lower Fed funds rate when the economy is below, growing poorly, below its trend. And of course the economy is well below its trend, and so the targets have been coming down when there was a quarter of really bad growth. but look how far below it's been, and this gap here is comparable to the worst gap here. It looks like we are sowing the seeds, if the Taylor rule is any indication. It's always dangerous, of course, to look backward and say, well, what indicator was signaling what actually happened, and then trust that to keep signaling into the future, because I think it's called the Lucas critique. No, it's called, you can always find winning stocks if you look backwards. Doesn't mean they're going to continue to outperform the market. But monetary policy is exceedingly loose right now. How long is it going to stay loose? How much of a credit bubble is going to build up? That's what we have to be worried about. Here's the story with real interest rates. Right? We saw before this period of negative real interest rates. We had one before. The only reason it's come back into the positive range is that we had a couple of quarters of declining prices. But I think those are over, so I expect we'll be back to negative Fed funds rate pretty soon. So that's not a good sign. Well, here's the dam that's holding it back so far. Right, we've doubled the monetary base, but monetary base velocity, that is how much that monetary base is turning over in purchases of goods and services, has fallen off a cliff. And it's declined by 70% based on the one-year moving average. What is that indicating? That's indicating that banks are sitting on their reserves. Banks have built up incredibly, unprecedentedly large excess reserves so that they're not lending, they're not creating twice as much M1 based on twice as much reserves. We did see growth in M1, right? 15 to 20% growth. So there is some pass-through, but much less than 100% pass-through. Why are banks holding such large excess reserves? Well, partly there aren't a lot of good borrowing prospects out there. And partly the Fed has begun to conduct an unprecedented experiment in the middle of this financial turmoil of paying interest on bank reserves. I'm not against paying interest on bank reserves, but I would like to do it at a time where we have sort of calm seas so we can estimate the demand curve for bank reserves and not kind of overdo it. Right now the Fed doesn't really know how responsive the demand for bank reserves is to the rate of interest they're paying on it. But banks seem to be happy to be holding huge, huge excess reserves right now. And the Fed's reason for introducing this new variable, this new tool, is that it gives them another way to try to manipulate bank behavior. So if they don't want banks to lend the money out too quickly because it'll be inflationary, they can raise the Fed funds rate. If they do want banks to lend money more rapidly, they can lower the Fed funds rate. Sorry, not the Fed funds rate, the interest rate they pay on reserves. They can lower the interest rate they pay on reserves, then banks pay a bigger penalty for hanging on to reserves. Well, they're sort of trying to learn to steer the boat in the middle of a storm. Not the best time to learn. So what's the current status of inflation and real output? Well, nominal output actually had a negative quarter. And that's not good. I like, if we're going to have a central bank and give it a policy target, I kind of like stabilizing gross domestic product so that when productivity grows, prices fall. If productivity falls, prices can rise a little bit. Don't try to offset growth in the economy, but do offset changes in velocity, and do keep the money supply from growing in ways that inflate nominal output. We went a tiny bit too far beyond what I'd like to see, but so if we could just stabilize it there, everything would be okay. So in a way, I'm saying, and I guess Steve said something like this in the last lecture, I don't, given that he's created a situation in which bank reserve demand has gone through the roof, I don't fault him for trying to meet some of that by expanding the monetary base, Because ceteris paribus, if he hadn't done that, we'd have had an even steeper decline in GDP. I do fault the way he's done it. There was no reason to do it by creating favored groups of borrowers and lending them hundreds of billions of dollars here, there, and elsewhere. It could have been done through open market operations. Right? That would have been straight straight monetary policy. He's doing fiscal policy. He's playing favorites, and it's created a situation where it's much more difficult to undo the expansion. So here's the lower chart is what's happening to the GDP deflator, and I guess we saw this before. It's still bouncing around in the range between 2 and 3%. Well, if inflation's 2%, but the price level times real output is shrinking, that means real output is shrinking pretty badly. Should the Fed react to that? Well, that's not going to last. So when the Fed reacts to changes in velocity, it should be very cautious about doing so. It's difficult for the Fed, like anybody, to predict changes in velocity. So slow reactions are less likely to run the danger of too much too late, and thereby making the economy more volatile rather than less volatile. But that's where we are now, and going forward, somebody asked me in the last session my own investment strategy. Well, I've been too much of a buy and hold person and not re-examine the risks of holding stocks coming up to 2007, but I do try to diversify beyond just the stock market into funds that do well when the dollar falls, because who knows, I might want to retire to Guatemala. And into inflation indexed assets. And Treasury indexed securities are a fairly conservative inflation indexed asset, assuming the default risk on Treasuries doesn't get too high, assuming they continue to pay off on them. But the other possibility, which I personally haven't done much but makes perfect sense to me, is look at commodities. And I can't time the commodity market, so I wouldn't recommend that. But buying and holding commodities as some share of your portfolio is prudent. And I heard a remark I liked the other day from somebody who said, well, you don't buy gold to make money, you buy gold to have money. Right, when everything else falls apart. All right, so thanks, and I'll take questions.
Commented on his blog that he's having his investors move into foreign markets. Do you think there's some, I think he's talking especially about China right now and some of their markets. Do you think there's light kind of for investors anywhere else in the world, or do you think everywhere is right now too unstable?
I don't know if you know Jim Rogers, the investment biker. He's not only moved his investments to China, he's moved to China. And he has his kids learning Mandarin. Well, yeah, it makes sense as a way of diversifying your portfolio to invest in asset markets other than dollars, other than the dollar market. But you want to. I made the joke about retiring somewhere else, because if your retirement is going to be in the U.S., then you want your retirement income in dollars. So if the dollar rises or falls against other currencies, doesn't make that much difference to your retirement income. But it does sort of provide some diversification against, it helps your performance overall to be more stable if you diversify away from the dollar to some extent. You don't want to overdo it. But yeah. Again, I don't think I can time changes in exchange rates, so I'm not suggesting that, but
yeah, no, not even trying to.
But there are plenty of mutual funds that invest in diversified portfolios of foreign securities. Yeah.
We have all seen how after Donaldson, the American,
Oh, well, I'm always in favor of cutting tax rates. But I give that recommendation at the height of the boom, too. Yeah, I don't really think that we can moderate business cycles by adjusting fiscal policy, either on the spending side or on the tax side. I'm just in favor of less taxes and less spending at all times. But I think it will help. I mean, having a more flexible economy helps adjust to correct the errors of the past, and so deregulation and tax cuts make the economy healthier in that way, and so should actually help speed the recovery. But you know, I'd be in favor of that even during the boom, as I said. So I'm not pushing it as a sort of clever counter-cyclical policy. Other questions? Yeah.
Given the budget deficit, there's going to be rapidly expanding treasury debt going to the market.
Right.
And while open market operations focus only on short-term obligations, the Fed has recently started buying long-dated bonds.
Right.
Along with State Bank of England and the Swiss Central Bank. Do you consider this to be an expanding trend that will keep long-dated treasury yields from going up?
Okay, so the question is, the Fed has traditionally invested only in short-term treasuries. Now they've started to invest more in long-term treasuries. Will that have an impact, and will they keep it up? Whatever the Fed's typical investment strategy is, changing it in order to try to influence the difference between short rates and long rates worries me. It's sort of monkeying with the market. And the market can adjust to any given strategy, but if the Fed starts changing its portfolio, its maturity composition of treasuries at its own whim, I can't see that having any real benefit, but I can see it creating confusion in the market or making everything riskier in the market, and so making people more reluctant to invest long term, which is not a good thing. There isn't any particular reason for the Fed to buy only at the short end, except that, well, let me think. It gives the Fed less interest rate risk, I guess. Not that it really matters for the Fed. The Treasury used to traditionally issue a whole range of maturity classes. In recent years, they've stopped issuing so many at the long end and focused on the short end. And I like that change because it put the Treasury on a shorter leash. Right? They couldn't inflate away or encourage the Fed to inflate away as much of the Treasury's debt because it was being refinanced that much faster. It was rolling over that much faster. So actually, one of my fiscal policy recommendations would be require the Treasury to finance everything at 1 week maturities. And then they'd be punished by the market every time they raised inflationary expectations. Just kidding. I was at a conference last week on the prospects for hyperinflation. Now, this is a cheery topic. And there is, a worrisome scenario. Some speakers at the conference talked about how hyperinflation had gotten out of hand in Brazil and in Argentina. And it's a story that we're uncomfortably close to replicating. Of course, it can't happen here because it hasn't happened here yet. Just like some other things we looked at. But the scenario is the U.S. runs bigger and bigger deficits. They can no longer finance them at cheap interest rates because the Chinese wise up and other foreign investors wise up and are not willing to absorb unlimited amounts of U.S. dollar debt, realizing that it might be inflated away. And so the last resort, and the taxpayers won't stand for much higher taxes. And if you look at U.S. federal taxes as a percent of GDP, it's been pretty stable for a long time at about 23%. If that represents some kind of balance of political forces so that it can't go much higher than that, then the last resort is printing money. And when that starts, the whole boat can tip over pretty quickly, and that's what happened in Brazil and Argentina, where when borrowers suspect that you're going to inflate away your debt, then you can't borrow as much anymore, and you have to resort even more to printing money. Other tax revenues begin to shrink because the economy starts shrinking, starts suffering from high inflation, and the only way to pay the bills, unless the entitlement programs are scaled back, is to print money. So what's going to prevent that from happening? Well, either there's got to be entitlement reform. Well, I guess that's what there has to be, given that I don't see there being, I don't want to recommend higher taxes, and I don't think higher taxes are going to sit well. I think a Congress that tried to institute, Social Security taxes, say, high enough to make Social Security solvent would not be reelected. There needs to be entitlement reform so that the, growing debt that's being shifted to future generations stops growing so fast, stabilizes to a point where a growing economy can catch up with it, and it doesn't become a chain letter scheme. But just another gift from my generation to yours. Yeah. Okay, so the question is, how important has been the effect of policy uncertainty, or regime uncertainty it's sometimes called. I've read Amity Schlei's book about the Great Depression, and she puts emphasis on that as a reason why investors stayed on the sideline. It took an awful long time for private investment to recover after 1929, after Hoover began monkeying around and FDR began monkeying around. And I think that is a real danger. I haven't thought about how to sort of put a finger on how serious it's become in the present circumstance, but I have the sense that it could become important. When there are sort of open-ended threats to the security of property rights or to the security of investments, what was the phrase? The men of mind go on strike? There is a danger of investors in their rational self-interest pulling up stakes and moving to some more hospitable climate, or just refusing to do anything risky, which is not good for economic growth. So regardless of whether we get double-digit inflation or worse, my real fear is that we'll have sluggish growth for the next decade. We'll go down the Japanese path if we don't eliminate that kind of uncertainty.
Just going off of that, with the calls for regulation of financial instruments and things, do you think we'll end up with a very low-risk society, with an economy where people just aren't willing to take any risks, and that will destroy our chances of deeper?
Okay, so the question is, do we face the risk of sort of shifting into a risk-intolerant economy where people just don't want to take risks? Well, I like to think that if there's a reward for taking risks, that there will be people who have the courage to do it. The question is, will there still be a reward for taking risk, or will it be, if you succeed, we tax it all away, and if you fail, we give you a handout, a bailout? Yeah, that's not the kind of encouragement we want to send to investors, or discouragement. I wanted to say something else about policy uncertainty that just occurred to me, because I see Roger Garrison sitting over there. He and I actually co-authored a piece that he contributed this argument to and has argued in other places. One of the problems with running a big deficit that's kind of hidden from view is that nobody knows how it's going to be financed. Right? When they pass a spending bill and say we'll borrow the money, they don't at the same time pass a bill that says here's how we'll repay the money. So you don't know. It could either be they keep borrowing the money from abroad, which means the dollar falls in value, or we borrow it from domestic savers, which means the interest rate goes up, or we borrow it from the Fed, which means the money supply goes up and we have more inflation. So it's got to be financed somehow by some combination of those three things. but we don't know what it is, and we don't know what future taxes are going to be imposed in order to pay it back. So that discourages investment in that kind of environment. Well, no more questions. We'll take our break now. Thanks very much.